Hi there, welcome to Kneppy Invest. Over the past 4 or 5 months, I have released a technical update every single Sunday, like clockwork. And there is a possibility, just a possibility at this point in time, that this might be the last regularly released technical update. The main reason behind that is because in the past week, I have started doing daily updates. And the type of companies I featured in my daily updates are the type of companies I probably would have featured before I started doing daily updates in my technical update. So there's no point doubling down on looking at those companies. So I thought instead of just finishing the technical update last week, I'll do sort of a final edition. And even though I'm calling it a final edition, doesn't mean this will be the last technical update, because if I stop doing daily updates, I'll go back to doing my weekly technical update. But in today's video, instead of looking at individual companies, I am going to have a overall look at the state of the markets. Now, I used to do a state of the markets video, and then for some reason or not, I stopped doing those videos. So fairly similar style that I'll be looking at the indices, starting with the XJO. We'll also have a look at the XSO on the ASX, which is the small ordinaries. Also have a look at the Nasdaq, Dow Jones, also possibly the S&P 500. Have a look at some of the commodities: gold, uranium, copper, oil, iron ore, even lithium. Maybe have a look at the DAX, UK 100, Russell 2000, that sort of thing. Also, maybe have a look at the bonds, because I also not only will be looking at indices, also show two market indicators that are looking really interesting right now in terms of market breadth on the Nasdaq, and also have a look at the yield curve inversion. And hopefully you've heard about that, because it's been in the news quite a lot over the past few years. But first of all, let's have a look at the XJO. And the main thing I'm looking for here is any sort of trends. Is the markets going up? Are the markets going down? Or the market's doing absolutely nothing? And in fact, when we look at the most of the indices, I'll be showing you in today's video, that last one is what's happening. Nothing is happening at all. So this is the XJO since late February 2022. And in fact, in late February 2022, the XJO was at very similar levels than what it is now. So over the past 15 months, the XJO has gone absolutely sideways. Now, of course, it doesn't go sideways in a straight line. We have seen it reach as high as 7,600 and as low as 6,400. And that happened twice, back in June and September of last year. Maybe not sort of, but definitely a double bottom. Now, even though I've mentioned a signal there, a double bottom, a technical signal, a double bottom, I have heard some people say we are going through a head and shoulders pattern right now. And so if you can see my mouse here, here is the left shoulder, here is the head, here is the right shoulder. Typically, head and shoulders is a bearish pattern. But the thing you have to understand is patterns aren't always 100% accurate. So just because that is a bearish pattern or looks like a head and shoulders doesn't necessarily mean it is definitely head and shoulders, and which doesn't mean the market is going to go down from here. But different sort of patterns have different sort of success rates, and head and shoulders is one of those patterns that does have a high success rate, just like double bottoms, triple tops, that sort of thing. So if you look at the daily XJO right now, nothing's happening. There is no trend, which means, if a good way to look at it, the bears and the bulls are always fighting. And if the market's going up, that means the bulls are winning. If the market's going down, the bears are winning. In this case, it's an even tussle between the bears and the bulls. And that's why over the past 15 months, the XJO has gone absolutely sideways. But I do know over time, the markets go up. That's an absolute truth. So let's have a look at a different time frame for the XJO. Let's have a look at the monthly time frame. Going all the way back, actually we'll zoom in a little bit. Going all the way back to the GFC. So this goes back to 2006. And what's been happening over the past 14 years is that the XJO has been trading in a channel, an upward sloping channel. Exactly what you want to see and exactly what happens in the markets, because over time, the markets go up. And when I say over time, I'm talking about years and years, not months or weeks or months, but over years, over a year time frame, 2 years time frame, 5 years time frame, maybe not 1 year, but over 5, 10 year time frame, there is a good possibility, a good probability the markets will go up. And that's definitely true when we look at the XJO. So it's been trading in this channel, which means whenever it gets to the top of the channel, we see a little bit of weakness. Whenever it gets to the bottom of the channel, we see a little bit of strength. And only one time during this period has the XJO gone below the channel, and that was during the COVID-19 financial panic, which is understandable because everyone, including their dogs, was panicking during that time period, and it got as low as 4,400. Now, I will mention. So right now, I'll mention this a little bit in a second. Right now, the XJO is right in the middle of the channel, which means it could go up, it could go down from here. So if the XJO was towards the top of the channel, I'd be probably a little bit more bearish. If it was the bottom of the channel, I'd probably be a little bit more bullish. But right now, it's in the middle. So I'm neither bearish nor bullish. And to be honest with you, that is the overall state of the market right now. Now onto the long-term trend, which is this blue line, dark upward sloping blue line down the bottom. And this has been in place since the early 1980s, the start of this particular chart. And if we actually go back to the 1980s here, so zoom in. So every single time the XJO has hit that long-term uptrend line, that sloping blue line, we have seen a bounce. It happened in 1990, 1991, also 92, 93. It also happened during the GFC. The XJO hit or almost hit that uptrend line and we saw a bounce. That was a low during the GFC and also during the COVID-19 financial panic. The XJO got very close to that uptrend line. In fact, it only fell about 200 short of that. So the low during the COVID-19 financial panic was 4,400. At that point in time, that uptrend line was 4,200. And I know that because at that point in time, I was thinking if the XJO got to 4,200, I would go all in because there was a high probability based off this trend line and based off the very fact that the XJO bounces off a trend line that we would see a bounce. Now, at that point in time, and my biggest mistake was that I had a specific price target of 4,200. It should have been more like a zone because the XJO didn't quite get to 4,200. 4,400 was its low. And even though I was buying at that point in time, I didn't go all in. So the main thing right now is that there's a lot of uncertainty about which way the XJO is heading in the short to medium term. But in the long term, the XJO is moving upwards. Now let's have a look at the XSO. And if we have a look at the monthly time frame for the XSO, not quite as bullish as the XJO. And in fact, the high, all-time high for the XSO, which is a small ordinary, so this is small caps on the ASX, the all-time high for this index was back in 2007 when it got to 4,200. We've yet to see the XSO get back up to those levels. In fact, the highest it's got since then was 3,600 back in late 2021. So not quite as interesting as or bullish as the XJO over the longer term. But if we have a look at the daily chart, we see a similar thing when we look at the XJO. The XSO is just going sideways. In fact, it's been going sideways for almost exactly 1 year. In fact, you could argue that the volatility in the XSO has been decreasing. So we're not getting those big movements from the lows to the highs like we saw back in June or between June and September last year. In fact, the highs and the lows are becoming narrower and narrower between each other. And you can definitely see that as these green lines or these green areas and red areas becoming narrower and narrower and smaller, which means the XSO is trying to consolidate. And the good thing about a consolidation period is when we do see a breakout, that's a good sign moving forward. And hopefully the breakout is to the upside. Hopefully, the XSO gets above 3,080, which is the top of this trading channel. If it gets below or goes below 2,600, that would be a bearish sign moving forward. There's a possibility that happens if we move into recession, which I'll talk about later in the video when we look at the yield curve inversion. So that's the XSO. So XSO, XJO, neither of these indices are looking bearish nor bullish, just going sideways, just going consolidating. And that is sort of what we see on the Dow Jones. So the Dow Jones sort of also going sideways over the past few months. In fact, really since about November of last year. So neither bullish nor bearish when we look at the Dow Jones. If we take a look at the S&P 500, we're starting to look at something that's getting a little bit more interesting. I could even argue that there is a potential breakout on the S&P 500 because right now it's at 4,200 or just below 4,200. The previous highs we saw in February was 4,200. Then we saw a little bit of weakness. And if we see a breakout above 4,200 on strength, that could mean that the S&P 500 is moving into an uptrend. So unlike the other 2 or 3 indices I've showed you, this is a little bit more bullish, but not quite there. And definitely not quite like we're seeing on the Nasdaq. The Nasdaq is definitely bullish right now. The Nasdaq is definitely in an uptrend for a few reasons. So the Nasdaq was in a downtrend, which is portrayed by this sloping downward line up until the start of 2023. The Nasdaq actually fell from 16,500 down to a low of about 10,500 over about a year's period. And then that uptrend downtrend was broken on, we'll say it was broken on the 23rd of January of this year. And then the Nasdaq moved into a nice uptrend. And we also have seen in the last 2 trading days a breakout above the previous high we saw back in August of last year. And we saw a nice little run up in the Nasdaq from June, middle of June through to the middle of August, so a 2-month period, and then it fell away again. And what we wanted to see was the Nasdaq break above that previous high in August, and it did it 2 days ago. So this is definitely a way more bullish pattern or chart than what we have seen in those other indices. So what's going on here? What's leading to the Nasdaq rising? Well, it's really interesting because it's not all the companies on the Nasdaq that are rising. It's only a few select companies. And in fact, those select few companies that are looking quite bullish right now are high quality companies. Probably some of the highest quality companies we have ever seen on the equity markets. And we can see that just by looking at some of the American companies. So I'm going to take you to my USA watch list here. So this has, how many companies does this have now? Up to 192 companies. So this includes all those big companies. We're talking about Apple, Microsoft, Alphabet, Nvidia, Amazon. Those are the big companies. I forgot it, Meta. You could maybe even include Netflix, although I don't think Netflix is quite as much as a high quality company as those other companies. Now, let's have a look at some of the charts for those companies. These are the high quality companies, the sort of companies you want to own for the long term, or have hoped you've owned for the long term over the past 10 years. So Amazon, probably the less bullish out of all these companies, has moved into an uptrend, has broken above the previous high we saw back in January. So this is the last of these big companies to move into an uptrend. So that should be a sign what's moving forward when we look at the other charts for these companies. Netflix has been an uptrend for a while after a bit of a scare because of decreasing subscribers. They're back to increasing their subscriber base. And over the past year, the Netflix share price has gone from $170 all the way up to $365. So it's doubled in share price in the past year. So definitely bullish chart here. Now onto Alphabet. This has turned really bullish over the past month. It went from being, remember there was that AI scare with this company because one of their AI program did something wrong. The market got a little bit spooked, sold down, and since then, Alphabet's share price has been an absolute tear. In fact, the share price has increased from $84 to $124. So we have seen a 50% increase in Alphabet's share price. Keep on seeing Google in Alphabet's share price. And the last time the share price was this high was way back in August of last year. Not quite as bullish as Nvidia. So Nvidia's share price has almost tripled from its lows. This is probably the most bullish chart out of all these companies. Share price has increased from $110 to $312. over, we'll say, when was October? October, so we'll say about 7 months ago. Then on to, we'll have a look at Meta or Facebook. That's definitely, sentiment in this company has definitely shifted over the past 6 months from highly negative in November. Share price got down to 90, now it's $245. So just like Nvidia, share price of this company has almost tripled over the past 5 or 6 months. Microsoft, this is looking bullish as well. Share price is heading towards its all-time high after being in the downtrend. And Apple, just like Microsoft, is heading towards its all-time high. So all these companies, these big, high-quality companies on the Nasdaq or the New York Stock Exchange, I think most of them on the Nasdaq, are in uptrends. That's not what's happening to every single company on the Nasdaq. It's only happening to a few. And we know this by looking at some of the other charts of these companies, but we won't do that. Instead, I'll show you the ARK Innovation Fund. So the ARK Innovation Fund, or Kathy Wood's fund, well, one of her funds, is really interested in innovative companies. And most of the innovative companies are not profitable. They're those tech companies, biotech companies that have great revenue growth or potential of great revenue growth, but typically are not profitable. Some of them are profitable. But when we look at the ARK Innovation Fund, it's going sideways right now. It's not in an uptrend, unlike those big high-quality companies. And this is very typical about what's happening not only on the Nasdaq broadly, but on those other indices. So all those other indices are going sideways, consolidating. This is ARK Innovation Fund. So what's happening on the Nasdaq right now is market breadth. And I'll just show you a tweet here. So this tweet here is from Daily Shot, saying the Nasdaq composite breadth remains weak. So what we want to see, when an indice go up, the majority of companies on that indice should go up as well. So there should be a positive correlation between the Nasdaq, the S&P 500, the Dow Jones, and the advanced decline line. And the simple way to think of this is, if the market is going up, the majority of companies' share price should be going up with it. If the market's going down, the majority of the companies' share prices should be going down. And on this particular graph, whatever you want to call it, there has been that positive correlation until February, March of this year, where we have seen divergence on the Nasdaq. So even though the Nasdaq has been going up or climbing, the majority of companies on the Nasdaq have actually been dropping in share price. So whenever I see divergence, I see weakness and a potential change in the trend. So even though the Nasdaq is going up, this is actually weak. Now, an argument against me saying this is weak is the thought that the first group of companies that should move up or should start a bull run are those high quality companies. And then after those high quality companies start going up, you see those lower quality companies going up, and then eventually small cap companies going up. So this could be the start of the next bull run on the markets, because those high quality companies are starting to go up. But this is making me a little bit more wary that we are seeing this divergence right now, that the majority of companies on the Nasdaq are still looking really weak. So that's looking at those particular indices. I also mentioned, I was going to look at a few others, didn't I? I said the DAX. Let's have a look at the DAX. Okay, so there's one reason I want to look at DAX, and that's because I am a shareholder of a few German companies. And even though the Nasdaq looked really bullish, this is even looking bullisher. In fact, the DAX is almost at an all-time high. That's the all-time high, which was reached in 2022. I think it's the all-time high. Yep, all-time high. And I'm not sure why there's so much bullishness in the German market right now, but it's definitely been going up. In fact, it's increased from 12,000 up to 16,200. So that's a 33% increase in the DAX since its lows back in October. I think the UK is not quite as bullish, sort of more like the other well, it's a little bit more bullish than the other indices. But overall, DAX is the most bullish, followed by the Nasdaq. And I'm very happy about the DAX because I do have a few companies that are listed on the DAX or the German market. So that's all. Let's look at the Russell 2000. So the Russell 2000 is sort of a combination of the the New York Stock Exchange and the Nasdaq, and this is fairly similar to those other indices. There's no definite trend in this index right now. So top 2,000 companies on the New York Stock Exchange and the Nasdaq, and this is just going sideways right now. So again, no trend in the Russell 2000, just like the XJO, just like the XSO, just like the Dow Jones. I think that's all I have for the indices. Let's have a look at the commodities. And the first one we're going to look at is gold. This is really interesting because if we look at the weekly chart, and we can see why this is interesting, and zoom in. So gold went through a really nice bull run during the period between 2019 and towards the end of 2020. In fact, gold went from about 1200 up to 2080. And then as soon as it got to 2080, would have been about July 2020, we did see it pull back a little bit. And then gold tested 2080 again in March 2022. And you can see this 1 week candlestick in the 7th of March week, 2022, where gold got up to 2080 and then slid back. So a lot of selling of gold during that period. And then gold fell all the way from 2080 down to 1640. But since that lows back in October, November of last year, gold has been on a really good run. And gold got all the way back up to 2080. And then what happened? We saw selling. In fact, you can see the selling when we look at the daily chart. In fact, on one day, on the 4th of May, the gold price got above 2070 for a very brief period of time, hit 2080, and then we saw selling. We know there was a lot of selling because on that day, on that 1 day candlestick, we have a long tail to the top of that candlestick, which means there was selling, and then that weakness continued into the next few weeks. So this happened 2 weeks ago, and the gold price has fallen from 2080 down to 1977. But in saying that, gold is still in an uptrend. This is just possibly a buy the dip situation. And without doubt, I can say this with 100% certainty, gold will eventually get above $2,080. It could happen tomorrow, next week, next month, 1 year from now, 5 years, 10 years. The only way it won't get above $2,060 or $2,080 is if something significantly bad happens in the world, like a zombie apocalypse or something like that. And the probability of that is almost zero, in my opinion. And maybe I'm being a bit too optimistic by saying a zombie apocalypse is virtually not going to happen. Uranium, beautiful looking chart here. Have a look at the weekly chart. But this has been an uptrend since about middle of 2020, still going up. I used to own a couple of uranium companies in my portfolio. Then I sold them to take profits, and uranium prices keep going up. But those companies' share price are not going up. So a bit of a divergence where the commodity is going up, but the company in themselves share price is really not in an uptrend, which is really interesting. Now, usually you'll see companies who are mining uranium or want to mine uranium is probably the better way to say that. You probably see or should see the share price of those companies going up if uranium is going up. And definitely uranium is in an uptrend right now. Bitcoin, should I look at Bitcoin? Yeah, why not? Let's have a look at Bitcoin. Because a little bit more bullish about Bitcoin, it has moved into an uptrend after reaching its lows of 16,000 back in November. It almost doubled to the next high back in, which was in April. We have seen a little bit of pullback in Bitcoin and Ethereum, but this could be just another buy the dip situation. So those of you who are really keen on cryptocurrency, maybe now is a buy the dip opportunity for you, because just like Bitcoin, Ethereum also has seen a little bit of weakness in the past month or so. So possibly another buy the dip situation here. Copper, I have changed my tune when it comes to copper. I was bullish, now I'm bearish just because of the technicals here. And hopefully you've heard of Dr. Copper. So there is a suggestion that copper is sort of an indicator of the health of the economy, hence Dr. Copper. And when there's a lot of demand for copper, the economy should be strong. When demand for copper is low or weak, that means or should mean that the health of the economy is weak. And because copper is looking weak right now, that's possibly an indication that maybe we're heading towards a recession. I'll talk about that when we look at the yield curve inversion later in the video. Nickel, on the other hand, is looking bullish. Has been looking bullish for a while. This is the weekly chart for that commodity. And in fact, it's been looking bullish since 2018. Beautiful chart there. Oil, bearish. when we look at the daily chart anyway. So even though, just zoom out there, even though the price we're paying at the petrol stations haven't really decreased all that much, oil has gone down significantly since its peak in June of last year. It reached about $122 a barrel, and it's been now as low as $65. But in saying that, we have seen two bounces off 65 in the past 2 or 3 months. The first time was on the 20th of March. We saw a beautiful bounce. In fact, oil went from about $65 up to $83, and then we saw it pull back again. And then on the 4th of May, we saw another really bullish one-day counterstick with the main body well above the low of the day. In fact, as soon as oil fell below about $67, and definitely below $65, we saw a lot of buying coming in, and we have seen oil bounce. In fact, right now at $71.83. Doesn't mean $65 is the absolute for oil, but that's a good sign that we have seen two bounces off that price. Well, maybe not a good sign, because I want petrol prices to go down. And I don't own any energy companies in my portfolio right now, I don't think. Or maybe, yeah, I do own one. Anyway, so oil, I've seen nice, even though it's bearish, when you look at the daily chart here, still in the downtrend, we have seen two bounces, which might be an indication that the bottom has reached, just might. Silver, fairly similar to gold. What else do we have here? Coal. Ooh, coal, gone down. Whoa, look at that. Sort of like the Matterhorn pattern, up the side of the mountain. We're all enjoying that if you're coal investors, and since then it's been just collapsing. As we get to the top of the mountain, it's just been going down ever since. In fact, it's gone down from $460 to $160, and more than likely, I think this eventually will fall through $120, because if you go back through history, coal prices have really struggled to get above 120, apart from what we've seen the last few years. And the very fact that we're going to see less and less dependency on coal in the future means there's going to be less and less coal mines approved, apart, except if you're from Australia, where we're seeing a lot of coal mines being approved by idiot governments in election that have been elected. Enough of a rant there. What else can we look at here? Iron ore looking a little bit more bearish right now. So it was an uptrend during the start of the first few months of 2022, but it's now in a short-term downtrend. And then lithium is really interesting too. We have to look at the weekly one here. Sort of like another Matterhorn pattern, a beautiful uptrend in the price of lithium up the side of the mountain. And once we got to the top of the mountain in, say, November 2022, the last time we saw a positive week was November 2022. Then we went to the side of the mountain, fell over the side of the mountain, and it fell all the way from $85 down to $42.50. But the last 2 weeks, we have seen a little bit of a bounce. So the last 2 weeks have been positive for lithium, and we have seen quite a few lithium producers' share prices bounce as well. We haven't seen that quite a bounce in the lithium explorers. So a positive sign, possible positive sign when it comes to lithium. So what else can I show you in today's video? The yield curve. I've already mentioned this. And in fact, I've got two things to show you here. One thing I've never looked at before, but we'll start it with the one I do look at quite often, and that is the Fred yield curve. So this is a 10-year Treasury constant maturity minus 3-month Treasury constant maturity. We look at the max, which goes back 40 years, and we just, there we go. So what this is looking at is the difference between the 10-year Treasury and the 3-month Treasury. Typically, normally, the yield you get on the 10-year should be higher than the 3 months. That's what should be happening. So that's what it's showing here, the difference between the two. So when it's positive, that means the 10-year Treasury is greater than the 3-month Treasury. But on occasion, that's not what's happening. And typically, when we see the 3-month exceed the 10-year, which means this particular indicator goes negative, that's called a yield curve inversion. And typically when that happens, it indicates that there is a possible recession, not a possible, there is a recession coming. And in this particular graph, those recessions in the United States are portrayed by these green or gray areas. And you can see before each of these gray areas, the yield curve inverts, goes below zero, which means, again, the 3-month is greater than the 10-year. So it happened in 1989. There was a yield curve inversion, and then United States went into recession in 1990. There was a inversion in 2000 before the tech bubble burst, or the dot-com bubble burst. We also saw a yield inversion in 2007 before we had the GFC, and we also saw a yield inversion just before the COVID-19. So in a way, this indicator predicted the COVID-19, but not quite like that. I remember seeing the yield curve inversions and went, well, there's a possible recession coming, and I think there was a good chance we would have went into recession if we didn't have COVID-19. But what's happening now? Well, we're definitely seeing yield curve inversion right now. In fact, it's been inverted for a while, and in fact, we have never seen it this low. It's about 1.7 or negative 1.7. We have never seen the yield curve inversion get below 1 or -1 until right now. Now, I have listened to a couple of Cameron Harvey's, I think that's the name of the guy who created this indice back in the mid-1980s, early 1980s, and I have listened to him a couple of times. He's mentioned that the depth of the yield curve inversion really means nothing at this point in time. So even though it's at -1.9 or 1.7, whatever it is right now, that's not necessarily meaning that the recession we might get in the United States is going to be deep. But he also said a couple of really interesting things. He said the length of the yield curve inversion does mean there is a bit of correlation between that and the length of the upcoming recession. So if you have a period of time where the yield curve is inverted for a long period, that might mean that the recession might be for a long period of time. But the other thing he said was really interesting. Just because this indicator has been 100% successful in the past in predicting recessions doesn't necessarily mean it's going to be 100% successful in the future. In fact, he thinks this time is different because of what's happening with unemployment and employment. There's still a lot of jobs available in the United States. And the other interesting thing he said was a lot of the layoffs happening in the United States right now are in tech companies, the tech industry. And those people who have been let go by, say, Alphabet or Meta or those other tech companies, they're highly skilled, and those skills will be wanted by other companies. And more than likely, they won't be laid off for very long. They will be able to find jobs fairly easy. So he even said this time might be different. I sort of agree with him on that point, but if the indicator has been 100% successful in the past, should we ignore it? So even though the sample size is fairly small, so should we ignore that we are seeing a yield curve inversion right now? The other one I'm going to look at here, I'll probably zoom on this, is something I've just discovered recently. And the reason I'm looking at this is from the Federal Reserve Bank of New York, and this has a longer time period. This goes back to 1960. So this is, again, the 10-year bond rate minus the three-month bill rate. And this just includes more recessions than the previous one, which was the St. Louis Fed. And this goes all the way back to 1960s. And again, zero is right in the middle. And wherever seen the yield curve inversion, we have seen a recession. This is absolutely true. But if we go back to the 1980s, that's when we did see the yield curve inversion get below -2.5, according to this. They also have a probability of US recession 12 months ahead of term spread readings. And according to this, the probability of a US recession in the next 12 months is almost 75%. And only twice before has it been above 50%, back in the mid-1970s and early 1980s before the GFC. The probability of a recession was only around about 40%. During the tech bubble burst, only around about 40%. Even during the COVID-19 financial panic, about 30% or so. So this is something new that I've discovered just today. So that's really all I have for today's video. Another really interesting thing I did, maybe I can show you this very quickly. One of my watch lists is IPOs. So these are companies that have IPO'd on the ASX over the past few years, 148 companies. We haven't seen many IPOs, non-mining exploring company IPOs on the ASX in the past few months, almost zero which means there's companies out there who want to IPO, who are just seeing the state of the markets and went, no way. And the reason behind that is if you have a look, a lot of these companies that have IPO'd over the past few years, we see a very similar pattern, almost identical pattern in many of these companies. Look at Bird Dog Technology, downtrend. Bike Exchange, downtrend. We'll look at Carbon Revolution, downtrend. Credit, Clear, downtrend. Chimeric Therapeutics, downtrend. Close the gap. Even though I sort of like this company, still in a downtrend. Cypherpoint going sideways. DGL sort of in a downtrend. We can go through this and each companies, all these companies have listed on the ASX over the past few years. EP&T Global, downtrend. E-Roads, downtrend. Fiji Carver, downtrend. Felix Group, downtrend. Foss Group, sort of a downtrend. GDC, uptrend. A bit of a difference there. And that uptrend has only begun in the last few months after being in a downtrend. Gaffin, downtrend. In fact, they want to delist from the ASX because the market cap is like $1 million. And the reason why the market cap is $1 million is because look at that chart. When they listed on the ASX, the share price got as high as 95 cents. Current share price of this company is 0.7 cents. I'm hoping no one bought shares in this company when they IPO'd. So a very similar theme. If we go through all these IPOs, I'll try to do this fairly quickly, although in TradingView, you have to go a little bit slower. Hydration Pharmaceuticals Company, downtrend. High Pages, downtrend. Hexamer, downtrend. Isotana, downtrend. Intellicare, downtrend. Immecus, downtrend. Immercore, well, this one's going sideways, consolidating after a downtrend period. Until we get to IPD Group, and there is a reason why I am a shareholder of this company. This is probably the lone fighter among the IPOs on the ASX over the past few years. This is one of the only companies whose share price has been increasing because it's in the absolute right space. It's also profitable, which helps. A lot of these companies are not profitable. They are burning through cash. And as we know, what's been happening on the markets over the last year or so is those unprofitable, burning cash companies have been absolutely beaten to a pulp. We can go through this and all these companies, and there's very few companies that are looking bullish right now. Another one is a company that recently, LGI. I don't know anything about this company, but this is sort of looking like IPD Group. This company's share price is in an uptrend. Market cap on this company is 219 million. So I don't know anything about this company. No research on this company just yet. So common theme, look at these companies that recently IPO'd. More recently, Equity Story, downtrends, gone from 18.5 cents to 4 cents. Halo Technologies, downtrend. It just goes on and on. Bridge SaaS, downtrend. It's gone from 18.5 cents down to current share price of 3.5 cents. So common theme here is these small cap, unprofitable companies have been in downtrends. And I did hear someone say recently that maybe now is a time to start getting interested in these small caps, because when the market does turn, eventually we'll see these small cap companies rally. Who knows when that's going to be? It could be next week, next month, again, 1 year from now. And what I was thinking before, possibly the very fact that these high quality companies in the United States are running right now might be a good sign. It may not be a good sign because of the divergence, but it might be a good sign that we are the start of the bull run. And then eventually these small cap companies that have been absolutely punished by the market will eventually turn around. Not all of them will. That's probably fair to say, but some of them will, particularly those who are heading towards profitability, are heading towards free cash flow positiveness. So that's all I have for this video today. If you have any questions about anything I've mentioned, any companies, any indices, any indicators, I'd love to hear your thoughts, your questions. So leave them in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.